Mercifully, history has shown that in circumstance where social trust deteriorates, particularly social trust around the purchasing power of instruments denominated in fiat currency, that a fairly small investment in precious metals and precious metals equities provides sufficient insurance that one is taken care of. If you revisit the arithmetic in the 1970s bull market, at the beginning of that market, gold was selling for an admittedly price-controlled $35 per ounce. At the end of the cycle, it was trading at $850. What is that, a 20-fold increase? If 10% of your portfolio generated a 20-fold increase, you could afford a 50% decline in your debt and equity portfolios. If you want a less dramatic example, let's look at the 2000 to 2011 bull market, where the gold price went from $250 an ounce to $1,900. In fact, let's cut that number substantially. The circumstances behind explosive up moves in precious metals generate such extraordinary up moves in the precious metals that the amount of portfolio insurance that is delivered by precious metals and precious metals equities is such that the amount of precious metals that you need to hold in your portfolio relative to other asset classes is small. One of the things that happens when I address audiences like yours is they seem to discount the fact that precious metals bull markets don't, over the course of an entire bull market, generate 20 or 30% returns. They generate 300 or 400 or 500 returns. So while it isn't certain that we are in a precious metals bull market or will enter into a precious metals bull market, I believe that it's likely, and I believe that the upside in precious metals is substantial enough that a 10 or 15% holding in one's portfolio can insure against a 50% loss in other portions of a person's portfolio. And that's the sort of approach that I would suggest for your listeners. In my heart of hearts, if I'm right, and that we're 40% of the way through a precious metals bull market, in my experience, the second half of a bull market is much more dramatic than the front half. And if I'm right, I don't think that the silver price goes from $20 to $30 or $35. I think the silver price could easily, don't put this as a clickbait title, I think it could easily triple or quintuple from here.
Yeah.
I don't think that the gold price would be limited in a move from $1,800 to $2,500. A circumstance in our economy where the arithmetic that we talked about earlier played out in people's psyche means that I could see easily metals prices doubling or tripling, and I could see an intelligently constructed equities portfolio, not comprised exclusively of the penny dreadfuls, but some quality stuff. I could see that portfolio substantially outpacing the gains that one enjoyed in their precious metals. The point of all this is that while the circumstance that we talk about isn't a certainty, it is a strong enough probability, which is a bigger word than possibility, that people would be well advised to have at least enough of their portfolio in precious metals that it hedged or insured around the rest of their portfolio and, in fact, their lifestyle. Precious metals bull markets are brought on by fear buyers, first of all. Other asset classes respond less to fear. But now to your question. If past is prologue, in the 1970s bull market, given that metals hadn't moved for a very long time, it probably took 2.5 or 3 years of experience of inflation before the fear associated with inflation set into generalist investors. And I would suggest that we experienced the same thing in the 2000 bull market, meaning that the conditions precedent for the bull market were expressed in the market for a full 2 years or 2.5 years before the market itself responded. The market that we're in right now, I think, has experienced probably 40 years of benign climate, which is to say declining real interest rates, increased availability of liquidity. And the consequence of that is that people don't fear inflation. They don't fear disintermediation, and they don't fear the potential impact on the pricing of other savings and investment products that would occur as a consequence of higher interest rates. I myself believe that we're in a circumstance where faith in the economy and faith in the government remains very high. I do believe, however, that the reality of the depreciation of the currency that has thus far been acknowledged by the authorities, the 6.5%, relative to the nominal interest rate paid on savings products, 1.5%, as an example in the U.S. 10-year Treasury, will provoke a circumstance where ordinary savers look at the returns they get on conventional savings and investment products and understand that they need to defend themselves. Of more use, Ivan, I think, is the fact that fixed income instruments, bonds as an example, are increasingly an untenable part of the portfolio of the largest institutional investors in the world. It's a generalization, but a mostly true generalization, that for 40 years, the largest institutions in the world have run portfolios that were 60% equity, 40% debt. If 40% of your portfolio is generating a negative real rate of return, and you are responsible for the well-being of pensioners 20 years from now, or the operation of the Stanford University 20 years from now, or a sovereign wealth fund 20 years from now, what happens is that a full 40% of your portfolio isn't responding. And you need to make some changes. And it's precisely the disintermediation out of debt securities by the largest institutional investors in the world that I think will kick off the precious metals bull market. I think our retail people will be important, but I don't think they'll be anywhere near as important as the largest institutional investors in the world.
What you just said there, inflation hasn't been long enough. And that's what I picked up right at the beginning of your statement. Inflation rising again now is sort of new to the market. We've had two generations of Wall Streeters probably come, now in the system who have never experienced real serious inflation. And they're buying maybe this narrative that it's transitory still. I mean, do you really think we need to have like another year of these 7% CPI numbers before they get it?
I absolutely do. People's experience from 1982 to present has been different. And people have a wonderful thing to blame everything on right now. The big thinkers at least do. COVID. I was on an interview not too long ago, a Q&A interview, where the questioner actually said to me, the higher prices that we're seeing in oil and gas due to COVID. And I had to say, what? How on earth has the virus increased energy prices? It seems that one of the narratives around us today is that all of the economic dislocation that we face is due to COVID. The idea that it wasn't due to, say, a higher cost of capital or decreased sustaining capital investments in the energy business seemed to take second peak to COVID. I think that as normal people look at the fact that their bank account is generating 25 basis point or 1/4% return, if it's generating a return at all, while the purchasing power of the principal of that account is declining by 6.5%, while it may not generate a fear of inflation, will certainly generate a behavioral change around investing, taking into account the depreciation of the purchasing power of the dollar more and more and more.
So, Rick, it sounds like from what you're saying, there's this argument out there, there's an inflationary argument versus a deflationary argument. And I guess the deflationist point of view is this is all transitory. It's just COVID related. This is all temporary, and inflation is going to naturally come back down without having to raise interest rates, without having to take the pain of the Fed changing monetary policy. What is your take on that? Has the deflationist argument imploded at this point?
Theoretically, in a free market, the circumstance that we see is deflationary, which is to say there's too much debt in society. We need to liquidate debt. You liquidate debt through a cessation of borrowing and through a default cycle. So left to our own devices, the circumstance that we face is extremely deflationary. Deflation, however, is politically incorrect. The voters, to the extent that they have the choice, won't tolerate it. The voters would much rather face the consequences of their actions over 20 years than face them over a year and a half, meaning that the political class will do whatever they can to forestall the debt cycle. And the truth is, as we have stated earlier, investors have been trained over the last 40 years to expect a fairly benign outcome. And benign expectations are not the stuff of deflation. They are the stuff of inflation. So the odds are, given the extent to which the political process and confidence runs the economy, that the outcomes will be inflationary, meaning that the deflationary cycle that would result from an economy telling itself the truth around the unsustainability of current debt levels won't occur.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.